Hey there, fellow Canadians. Imagine waking up to discover that your retirement income has just received a significant boost. Sounds too good to be true, right? Well, stick around because I'm about to reveal some crucial updates from the Canada Revenue Agency that could put more money in your pocket and change the way you think about your retirement finances. Whether you're already enjoying your golden years or planning for the future, the information I'm about to share could make a real difference in your life. So grab a cup of coffee, get comfortable, and let's dive into the world of retirement benefits and tax strategies that could transform your financial outlook. Welcome back to Seniors Money, your trusted source for all things finance in your golden years. I'm Michael, and I'm thrilled to have you join me today for this deep dive into the latest CRA announcements and retirement strategies. You know, in my years of helping fellow Canadians navigate the complex world of retirement finance, I've seen firsthand how staying informed can make a world of difference. That's why I'm so excited about today's video. We're going to explore recent changes, uncover little-known benefits, and discuss strategies that could potentially add thousands of dollars to your retirement income. So whether you're a retiree looking to maximize your benefits or someone planning for the future, this video is packed with information you simply can't afford to miss. Recent CRA announcements. Let's kick things off by talking about the latest announcements from the Canada Revenue Agency. Now, I know what you're thinking. CRA announcements don't exactly sound like thrilling content. But trust me, these updates could have a real impact on your bottom line. The CRA has been busy lately rolling out changes that affect everything from tax brackets to benefit amounts. One of the most significant updates is the indexation rate for 2024, which has been set at 4.7%. This might sound like just another number, but it's actually great news for retirees. Why? Because it means that many of the benefits and tax credits you rely on will increase to keep pace with the rising cost of living. But that's just the tip of the iceberg. The CRA has also made changes to contribution limits for various savings vehicles, adjusted tax brackets, and updated several policies that directly impact seniors. Throughout this video, we'll break down these changes and what they mean for you in practical terms. Now more than ever, it's crucial to stay informed about these CRA updates. In today's rapidly changing economic landscape, being in the know can mean the difference between just getting by and truly thriving in retirement. So let's dive deeper into some of the specific changes that could affect your retirement income. When it comes to managing your finances in retirement, understanding the various tax credits and deductions available to seniors can make a big difference. Let's explore some of the key ones that could help reduce your tax bill. First up is the age amount tax credit. If you're 65 or older at the end of the tax year and your net income is under $96,309 for 2024, you may be eligible for this non-refundable tax credit. The maximum federal credit for 2024 is $8,398, which could result in tax savings of up to $1,259.70. However, the credit starts to be reduced when your net income exceeds $42,335 and is completely eliminated at $96,309. Next, let's talk about the pension income amount. If you receive eligible pension income, you can claim up to $2,000 as a non-refundable tax credit. This includes income from a registered pension plan, annuity payments from an RRSP or RRIF, and certain other qualifying payments. If you're not currently taking advantage of this credit, you might want to consider converting some of your RRSP to a RRIF, even before age 71, to create eligible pension income. The medical expense tax credit is another valuable deduction for many seniors. You can claim eligible medical expenses that exceed the lesser of $2,677 or 3% of your net income for 2024. This can include a wide range of expenses, from prescription medications and dental work to mobility aids and home renovations for medical reasons. Keep those receipts. Here's a lesser-known tip. If you or your spouse was born in 1959 or earlier, you may be eligible for the Canada Caregiver Credit. This non-refundable tax credit can be claimed if you're supporting a spouse, common-law partner, or dependent with a physical or mental impairment. Another credit to be aware of is the disability tax credit. If you have a severe and prolonged physical or mental impairment, you may be eligible for this credit. Lastly, don't forget about provincial and territorial tax credits. Many provinces offer additional credits for seniors, such as property tax credits or credits for public transit use. These can vary widely depending on where you live, so it's worth checking what's available in your area. Remember, tax rules can be complex and change frequently. It's always a good idea to consult with a tax professional or use reliable tax software to ensure you're claiming all the credits and deductions you're entitled to. Now that we've covered some ways to reduce your tax bill, let's talk about one of the most popular retirement savings vehicles in Canada, the Registered Retirement Savings Plan. Registered Retirement Savings Plan, RRSP Updates. Even if you're already retired, your Registered Retirement Savings Plan, RRSP, likely plays a crucial role in your financial picture. Let's discuss some recent updates and strategies for managing your RRSP in retirement. First, let's talk about contribution limits. For 2024, the RRSP contribution limit is 18% of your earned income from the previous year, up to a maximum of $31,560. This is an increase from the 2023 limit of $30,780. Remember, if you didn't use all your contribution room in previous years, that unused room carries forward. Now, you might be wondering, why would I contribute to an RRSP if I'm already retired? Well, if you're still earning income from part-time work or have a younger spouse who's still working, continuing to contribute to an RRSP can still provide valuable tax deductions. But for most retirees, the focus shifts from contributing to withdrawing from their RRSPs, where some strategic thinking can really pay off. While you're required to convert your RRSP to a Registered Retirement Income Fund, RIF, by the end of the year you turn 71, you can choose to convert it earlier if it makes sense for your situation. One strategy to consider is making smaller RRSP withdrawals earlier in retirement, especially if you're in a lower tax bracket. This can help reduce the size of your RRSP, potentially leading to smaller mandatory RIF withdrawals later on, which could help you avoid being pushed into a higher tax bracket or having your OAS clawed back. Speaking of RRIF withdrawals, it's worth noting that the minimum withdrawal percentages have been adjusted to reflect longer life expectancies. For example, at age 71, the minimum withdrawal rate is now 5.28%, down from 7.38% a few years ago. This change allows for more flexibility in managing your retirement income. Here's a pro tip. If you have a younger spouse, you can use their age to calculate your minimum RRIF withdrawals. This can result in lower required withdrawals, giving your investments more time to grow tax-deferred. Another strategy to consider is pension income splitting. If you're 65 or older, you can split up to 50% of your eligible pension income, including RRIF withdrawals, with your spouse. This can be a powerful tool for reducing your overall household tax bill. Lastly, don't forget about foreign withholding taxes if you hold U.S. or international investments in your RRSP. Unlike in a TSA, these taxes are generally recoverable in an RRSP, making it a more tax-efficient account for holding foreign dividend-paying stocks. Managing your RRSP and RRIF effectively can have a big impact on your retirement income and tax situation. But it's not the only tax-advantaged account you should be thinking about. Let's move on to discuss the tax-free savings account and how it can benefit retirees. I hope you found this information valuable and that it helps you make more informed decisions about your retirement finances. If you have any questions about what we discussed today, feel free to drop them in the comments below. I'll do my best to address them in future videos. Before you go, if you found this video helpful, please give it a thumbs up and don't forget to subscribe to Seniors Money for more valuable retirement tips and updates. Hitting that notification bell will ensure you never miss out on important financial information that could benefit you. Thank you for watching, and remember, it's never too late to take control of your financial future. This is Michael, wishing you a prosperous and enjoyable retirement. Take care, and I'll see you in the next video. If you know someone who could benefit from this information, please share this video with them. Together, we can help all Canadian seniors make the most of their retirement years. And don't forget to check out our other videos for more in-depth discussions on specific retirement topics. Until next time, stay financially savvy.